I've said the stock board we're checking right now, Dow off 750 points, S&P off 84, and the NASDAQ right now leading the way lower on a percentage basis, off nearly 3.5%. I mean, when you look at this, guys, it's obviously tied to the way that the Chinese have retaliated to what President Trump has called currency manipulation. When we look at it right now, the yuan falling to its lowest level since 2011.
Yeah, well, the challenge here is really where's the floor, right? So, I mean, you had the Chinese yuan getting devalued against the U.S. dollar, as you mentioned, USD to Chinese yuan, up above 7, and we haven't seen that in a long time, actually for a good amount of time. And I think the question here is really, where do we see this escalating? We've seen that President Trump has feared that the U.S. dollar would get stronger and stronger, and for those who maybe aren't familiar with the way that Forex markets work, that makes it harder for U.S. companies to export, and for an administration that is so heavily prioritized increasing U.S. exports, that obviously does a lot of damage. We've seen it in the earnings so far, in addition to all the business fixed investment issues that the companies are just broadly seeing because of the lack of global growth prospects, not just in China, but in the EU, for example, and domestically here in the U.S. as the Fed has eased rates because it's worried about what's looming around the corner. So there's a lot of questions about how far we'll get into this tariff war. And I mean, the worst case scenario would be this extending through 2020, which President Trump has said is a real possibility.
And on the short end there, too, Carlton, when we look at it, just in the short term, the way that the U.S. might respond to what the Chinese have just done here by devaluing their currency, when we look at it, I mean, on our side, you talk about 10% in terms of tariffs hitting about $300 billion worth of Chinese goods planned right now for September. But President Trump has talked about that potentially going up from 10 to potentially 20% as well.
Well, it's really interesting, though, because, I mean, how much of that can either side do? 10% of tariffs, you're talking about September, you're talking about heading into the holiday season, you're talking about heading into the 2020 election. So you can do that, but once that really starts to cripple U.S. business, I'm sure Trump would like to get reelected in 2020. He's been running on a strong economy. Once people really feel in their pockets that the economy is not that strong, I don't know that he'd be able to do that.
And once consumer sentiment starts to shift as well, potentially, if they see the sticker shock of what is about to come. But we want to dig deeper into the market sell-off that we're seeing right now. So joining us now on the phone to discuss is Heyman Capital Management founder and Chief Investment Officer Kyle Bass, along with Yahoo Finance's Julie LaRoche, who joins us in studio. Kyle, I just want to get to this first. Obviously, you rose to prominence calling the subprime mortgage crisis, and today's market action might be causing some flashback to the volatility that investors saw in years past. But what do you make of China's action and the market response we're seeing today?
Yeah, I think. Look, it's important to note that the frictions that are happening between the U.S. and China aren't just how much is a pair of sneakers going to cost when we buy them from Walmart. This is much bigger than the economics. This is all about the entire relationship between the U.S. and China, and I think it's important to note that this is about intellectual property theft. It's about industrial espionage. It's about resetting our relationship with a China who has been taking advantage of the U.S. for a long time. And now this isn't just about putting 10% tariffs on $300 billion worth of goods. Guys, if you think about it, the Chinese economy is supposedly roughly 12 or 13 trillion U.S. dollars worth of RMB, and the U.S. economy is 20 trillion. We're talking about, let's say we put 25% tariffs on the entire lot of 520 billion of imports. We're only talking about $125 billion on economies of 20 and 13 trillion. I think we can't get lost in, the bigger picture here. And it is the incompatibility of two economies butting heads with one another in their cultural differences. And I think we're seeing a microcosm of that in just the relationship between China and Hong Kong right now.
Kyle, you just mentioned Hong Kong. That's something I want to dig in on. It's Julia, by the way. You wrote this paper back in April that everyone should probably go back and read, The Quiet Panic in Hong Kong. We're seeing some serious news come out, delayed or canceled flights. We're seeing a strike in the city really coming to a standstill. What do you make of what's going on there, and just how significant is this? How should investors be looking at this?
Yeah, I think, again, as we all know, Hong Kong is referred to as a special administrative region of China. It was handed back to the Chinese by the British in 1997. And I think when you're looking at the relationship, I'm getting a little feedback on the line. Are you guys hearing something?
It might be the pictures that we're seeing right now play out in Hong Kong.
Okay, I apologize. So I think it's important to realize that this one country, two systems that Hong Kong has existed under since 1997 really depended a lot on how China took a hands-off approach to Hong Kong, and with its most recent enormous misstep trying to push through an extradition bill through Hong Kong's legislature, the people of Hong Kong are taking over. This is Xi's worst nightmare because he can't act like he acted back when Tiananmen Square happened and just quash the uprising because there are too many cameras watching, and Hong Kong has been free for too long. And so now you have the people of Hong Kong fighting for their lives, both their lives literally and their lives going forward in an existential crisis, because the people of Hong Kong know that whether China takes over today or in 2047, China is going to take over and remove all of the freedoms that they've had, for so long. And I think that what's happening right now in Hong Kong is the people can probably be kicked off the streets by the triads and the thugs that China sends in there to incite violence, but China can't make the people of Hong Kong work. So this big strike today is a muscle that's being flexed by the good people of Hong Kong, trying to again push China away from using their heavy hand in Hong Kong. The problem I see with it is there is no easy off ramp here. There isn't a solution where Beijing gets to save face that a popular uprising has changed the manner in which it wants to operate and rule Hong Kong. And the Hong Kong people can't back down either. Yeah. So I don't know where this goes, but I think there are more dark days ahead. And I'll point out that, again, from an economic perspective, Hong Kong's trade with the rest of the world is more than 3.5 times its GDP. And if Hong Kong is treated as China, the dynamics of Hong Kong itself will dramatically deteriorate. And I think that's what everyone's starting to realize today. Today, right this minute as we speak, the 1-year forward price of the Hong Kong dollar versus the U.S. dollar is actually trading through the band, through that peg of 7.85. It's trading at 7.8505. So that is an interesting precursor to what's to come.
Kyle, it's Julie again. So are you saying that we might be past the point of no return here with Hong Kong?
Yeah, I think if you listen to Carrie Lam's speech over the weekend, it was basically a ominous threat to the people of Hong Kong. Her exact words were, they're entering the most dangerous phase. It's engaging, or let's say it's verging on, quote, a very dangerous situation. And, we saw 2 million people in Hong Kong march peacefully. And then the peace was broken when, guys in white T-shirts with bats and machetes showed up, and they were the criminal gangs. Well, I think China had to incite the violence, and now you have a problem with maybe Chinese army or Chinese police coming in to, quote, restore order and let's say maybe even enact martial law. And when that happens, the freedoms of the Hong Kong people that they thought they would have until 2047 will be snuffed out.
Hey, Kyle, Brian Chung here. So you talked about the Hong Kong dollar. I'm wondering if we could also focus on the Chinese yuan, given all the news that we've seen today. Some might argue that this isn't necessarily manipulation so much as it is actually China allowing the market pressures to sink further on the yuan by loosening their bands, and that the market pressures were really what took it to 7 today. Where do you feel that the proper bottom is, given the pressures? And obviously there's concerns that were in China well before even the tariff wars that, the economy was slowing down at large. So where do you see the USD Chinese yuan really at its natural level?
Yeah, I think you mentioned natural, right? They have an absolute closed currency system. When you look at their economy, supposedly represents 15% or more of global GDP, and currency settlement in the Chinese yuan has gone the other way, and it represents less than 1% of global currency settlement. So we all take the Chinese for their word, and the funny thing about their manipulation, or whether or not they manipulate, they prop up their currency. They're trying to hold this whole ball of wax together, this whole charade that their currency is a real global currency. And when they finally have to let go and stop selling dollars to buy yuan, to maintain an artificial level, you see what happens to it. So they've done that a little bit today, and it's moving, roughly 2%. But if the yuan were to free float tomorrow, it would depreciate 30, 40% against the dollar. I mean, how many wealthy Chinese businessmen do you know that can't wait to invest more money in their own currency and send their kids to colleges in Beijing? I mean, every rich Chinese person in the world can't they can't do anything else but figure out how to get their dollars into Vancouver or the U.S. or London. They're trying to run with their money because they realize what the system really looks like.
Hey, Kyle, this is Carlton English here. I'm just wondering, we see China possibly with the currency manipulation, the threats to no longer buy U.S. agricultural products. What measures, aside from tariffs, can the U.S. take to counteract some of the recent actions or threatened actions from China?
I mean, I think what everyone must realize is, number one, when you see news, hi, Carlton, sorry. When you see the news, it's important to realize that the Chinese news agencies are just propaganda agencies, right? The Global Times, the China Daily News, Xinhua, they're all mouthpieces of the Chinese government, and they've been able to craft a narrative globally that somehow China has the upper hand. What I just mentioned to you is they don't have any dollars. They have a very low level of dollars. They built a pile of dollars up, hollowing out our industrial base, and they've been bleeding those dollars because they run a huge fiscal deficit. Their combined fiscal deficit is 10% of GDP. Their current account is now going to move into a deficit from now on indefinitely. And again, that's more technical and we can get into that. But basically, the flow of money is going to be out, not in dollar terms. And so when you say, what can the U.S. do? I mean, all four of the Chinese banks, the big four, whether you look at policy banks or SOE banks, they all are under, today they're under consent decrees with the U.S. Department of Justice for money laundering, and they all process payments to sanctioned entities in Iran and Russia and all these places. All the U.S. has to do is enforce its laws and sanction the big Chinese banks and take them off the SWIFT system, and that cripples China, i.e., they have to have dollars to operate, and they don't have any dollars, and we hold all the cards.
Kyle, really quick before we let you go, what are your thoughts on Bitcoin? We're seeing it move quite a bit on this news.
Yeah, I mean, look, if you're in Asia and China and you're in a closed currency system, or if you're in Hong Kong and you can't seem to get a big conversion of Hong Kong dollars to U.S. dollars, what are you going to buy? Well, you're going to buy anything that's nailed down. You're going to buy gold. You're going to buy Bitcoin. You're going to do whatever you can to get your money out of your regime that's falling. And I think that's what you're seeing happen globally today is if the world has a small recession, you already have $14 trillion worth of global bonds that are trading at negative yields. U.S. rates are going to go to zero. Then there's no negative carry, negative cost of carry of owning a non-yielding asset. But what's going to happen is all the central banks will go print more, and the price of every asset around the world, whether it's an apartment building, an office building, a Bitcoin, or a piece of gold, or whatever it is, the price of everything will go up nominally, but real rates of return will come down.
Well, Kyle, I just want to ask you, I know you got to run because we're seeing right now, I mean, you're painting a pretty bleak picture, but when you look at it, we started this interview by tying it back to the subprime mortgage crisis and the fears that investors had back then. As you're seeing this play out and painting that picture, I mean, in your mind, are we setting up for something on a similar scale?
Yeah, I think it's important. Also, let me compare what's happening in Asia to what happened in our crisis. In our crisis, we had $17 trillion worth of assets on balance sheet in our banks. And if you include non-banks like Fannie and Freddie, let's say we had $23 trillion. We lost about $850 billion of equity in our banking system in our financial crisis. China has $53 trillion worth of RMB of assets in their banks, and their economy is only 13. I mean, guys, we lost less than $1 trillion. I think they're going to lose $3 to $4 trillion if they have a crisis. And so this is bigger over there. But here, our banks are solvent. Our banks have recapitalized. And the U.S. is in great shape. We can weather a recession. We always do. I think over there, it's going to be much harder for them to weather the enormity of the credit crisis that they're facing. And I'll make one more point. You see the CEO of HSBC get fired today.
Yep.
They're one of the biggest banks in the world and one of the biggest in Asia. And when you look at the HSBC board, all of them seem to be HSBC lifers, right? It's the guy that ran HSBC in Czechoslovakia forever. It's the guy that ran HSBC, and you pick the domain. But that board doesn't have the gravitas really to get rid of that CEO. It's rumored around the marketplace that HSBC has been lending a lot of money to China to help them prop up their currency. And I think the Bank of England just figured it out. And so I think you're seeing the telltale signs of a real problem starting to snowball with these huge moves in currency, with these the bank CEO of one of the biggest banks over there just magically getting fired. I think there are a lot of things going on very quickly, and it's hard to assimilate it all. And you guys do a good job of trying to do so. But imagine if you had your money in Asia, how you'd be feeling right now.
Well, hearing that warning coming from you and a man who saw it all play out before a lot of other people did, I think carries that much more weight. Kyle Bass, thank you so much for calling in. Appreciate you taking the time.
Thank you.
All right, well, Julie, I mean, instant reacts to that. I mean, if he's saying that the subprime mortgage crisis here was a $1 trillion problem, he's basically likening it to a 3 to 4 times as big problem.
Right, and this is something that he's talked about going back just a few years ago. I believe, what was it, Carlton? You were covering this as well. It was probably 2015, 2016 when he came out with a big white paper. I know I covered it back then. Actually, I think it was beginning of 2016. Just the impending financial crisis, this credit crisis that China was facing, their banking system specifically, and drawing those comparisons. And when you put that number out there, just the enormity, it really does put things in perspective.
And I mean, realistically, I mean, when you think about it, nothing that we've talked about really in the globe, when we talk about the global economy, I think a lot of people had thought that some of these things would be contained. But as we move further and further along, as we're seeing what's playing out at the Fed in their thinking as well, I think people are starting to realize that nothing ever is contained.
Oh, absolutely not. I mean, if you look at, some of the laggards on the Dow today, last time I checked at least, it's the companies that are doing business in China, Apple, Boeing, Caterpillar, all hit by, what's going on today. I mean, there's no such thing as a self-contained economy anymore.
And for what it's worth, with the Chinese slowdown, it seems like not everyone carries the same kind of bearish view that Kyle does. There were expectations that China would slow down, but actually the first 2 quarters of data prints that we got from the Chinese, and you could argue to what degree those are honest, but it showed only kind of a slight tick down. I mean, in the last quarter, I think it was 6.3%, which is indeed slower than it's been over the past, especially 5-10 years in China. But I mean, that's still pretty impressive GDP growth. So as far as the momentum of that large economy, it is still, huge. But I mean, look, when you're talking about the escalating tensions between these two countries, these are the 2 largest countries by economies of scale. So anytime they're butting heads, I mean, that has huge global implications.
Going tit for tat for sure, as we continue to see what might happen with President Trump's response, potentially even coming back with a larger tariff to rebut that. But Julia Roach, thank you so much for bringing it down and joining us.